The assessment from the market is that the signal that you gave today is we are nearing or at the end of the interest rate hiking cycle. Is that a fair assessment?
Well, the way I would put it is that we've been saying up until now that in recent times that if the economy evolves and if inflation evolves as we think it will, rates will have to go up further. And we also use the word forcefully, which a lot of people picked up on. And you'll see today that actually we haven't said that, either of those things. So that's intentional. However, I'm not saying this is it, we're done, because the world is too uncertain at the moment. In our case, there is an encouraging downward path of inflation in our central projection, but there's a big risk. We've got the biggest risk in our forecast on inflation on the upside that we've ever had.
Well, you have downgraded your inflation forecast, which is interesting. And you also cite that there are some signs that labor demand is beginning to slow. If average private sector wage growth starts to slow down, would that be a signal to you that perhaps your work is done?
Well, I would say that private sector wage growth in particular is a very important part of the evidence that certainly I'm looking to see. By the way, of course, we look at inflation and wage settlements for the whole economy, but private sector settlements have been a very important part of the thinking as to what's shaping up as we expected. They have been above what we expected in recent months, but there is evidence now, and in two respects, both in terms of the sort of the shorter term path of reported wage settlements, and some of the surveys, and what I hear from with our agents when I go around the country, that is possibly beginning to change, but we can't really see it, firmly enough in the evidence yet.
And when you talk about monetary policy working with a lag, I see that's a new statement as well that you've put in. What sort of lag are you referring to? How long is it going to take for these rates to be transmitted?
It's not, if I may say so, it's not a new statement, of course, because there's a transmission mechanism of monetary policy. Monetary policy feeds through into the economy over a period, of at least up to around 2 years, and sometimes a bit longer than that. And the way it feeds through depends on structural features on the mortgage market and so on. So it does happen with a lag. And so one of the important questions, we've raised interest rates now, substantially in the last 12 months or just over 12 months now, very substantial. We've done a lot. Of course, we expect quite a bit of the effect of that is still to come through. So we want to see the evidence of that too.
And there's no pushback against what markets were pricing in terms of interest rates this time around. We did have pushback back in November. Markets are pricing in a terminal rate of 4.5 percentage points, and then for it to drop to around 3.25 in subsequent years. But even with that market pricing, you have inflation at 1.5 percentage points in 2024. So is another way to rephrase that monetary policy perhaps is too restrictive as per what's priced in?
Well, the problem is this. That's what we might call our sort of central projection. Unfortunately, there's some very big risks on the upside. I gave one example, or we have one example actually. We've had to switch because of what's happened in energy markets and some of the pricing policies that have been implemented in energy markets. We've switched from assuming that energy prices stay constant going forwards to using the futures curve. That means that we've actually got quite a rapid downslope of energy prices really throughout much of the forecast period. So if you ask me the question, but what if you went back to the previous assumption and you held them fixed? What would it do to inflation? It would add about 1% to inflation. So that's a bit of a sense. There's material uncertainty at the moment on that path.
And just a question on growth as well, because you also did upgrade your growth forecast for this year quite substantially, actually, from minus 1.5 to minus 0.5 for this year, still negative. Would you say that there are perhaps some upside risks to growth on back of better data that's coming out of Europe and a possible China reopening as well?
Well, I think there are a number of reasons why we moved our growth forecast up somewhat. Falling energy prices, one. A lower market curve of interest rates is another. And a view that actually we've revised our unemployment forecast down quite a bit, actually. We think that that firms, and that's what firms tell me when I go to see them, they'll want to retain labour as much as they can and possibly shorten hours rather than, fortunately, have redundancies. Now, we think that if that is the case, then that gives people more confidence in jobs, and that will put a bit more demand into the economy. So those are the things that really contributed to our revision of the forecast for growth.
And just final question, when the likes of the Fed start talking about nearing the end, you have other central banks as well signaling that they're also approaching the end of the rate hiking cycle. Is there a certain element of global coordination that's going on here?
Well, let me sort of make 2 points here. We do not coordinate monetary policy in that sense across central banks because we're each setting monetary policy for our particular setting. Do I talk a lot to other central bank governments? Yes, we do talk a lot. And we do talk a lot about the global conjuncture, about the shocks that are happening. But, I sort of have all of that in my head, but I have to go and, my colleagues, we have to set interest rates for the UK, just as my colleagues do for their countries.